Hello everybody. In the current affairs this week, the week ended 22nd September 2024. The major economic event of this week was the rate cut proposed by the US Fed to the extent of 50 basis point, which is 0.5%. And this rate cut has been proposed after 4 long years. The entire story, the way it goes is that at the time of COVID, all the economies of the world and also the major economies like the US went into a lot of slowing down on account of lack of demand, which was gripped by the fear of COVID. In order to boost demand and to see that the wheels of the economy go on moving, the interest rates were reduced very significantly. On account of this lowering of interest rate, and that too on a very sustained basis for a long period of time, this led to a lot of demand where free money was available, and that chased a lot of goods. This led to inflation in these economies. And now another problem was that how to counter that inflation. But at the same time, it has to be balanced that the economy was under a good shape, that despite the lowering of interest rate, it would not impact the demand and it would not slow down the economy. So it was a balancing act which the central bank of US had to do. And whatever US does, which is the largest economy in the world, impacts the entire world. The rates of interest which were rather increased in the US were of such a huge magnitude, which we can understand by the fact that on 1st of September 2021, the repo rate is the rate at which the central banks would lend to the banks to, in turn, lend to the borrower, may it be a corporate or an individual. On 1st of September 2021, in the US, the repo rate was just 25 basis point, which is 0.25%. And on 1st of September 2024, which is after 3 years, the rate of interest was 5.50%. So this was a very sharp increase, multifold increase in the rate of interest which was prevalent in that economy, which definitely impacts a lot of borrowers, may it be corporates or individuals, which will increase their interest rate liabilities in a very sharp way. Comparing this increase in the rates of interest during this period, which is 1st of September 2021, India had a repo rate of 4%, which is now on 1st of September 2024 is 6.5%. So the increase was definitely there in India, but was not to that sharp magnitude. Now, the way the central bank of US is comfortable with the rates of inflation in their economy, they have started going for the reduction in interest rate cycle. The first interest rate reduction, as I said, is 50 basis point, which is 0.5% in the repo rate. And it is expected in the year 2024, in the balance part of the year, another 25 basis point each, totaling to another 0.5% is something which is expected as a reduction in the interest rate which could be proposed by the Federal Reserve. The impact, in a simple analogy that we can draw, is that the moment the interest rates are on a decline in the US, monies of institutions and corporates and even individuals which are there in US, which were in the comfort zone of high interest rates, would then start moving towards the emerging markets. And as a result of that, the US dollar would slightly and mildly over a period of time weaken, and the emerging market currencies would appreciate. And also the monies flowing into the emerging markets would lead to the scaling up of the stock market levels of the emerging markets. This has been the trend in all these years whenever this interest rate cycle has played, and this is the way it has happened. Maybe will this happen this time? It could be with a lag, but yes, over a period of time it would happen. Every economy in the world is placed in its own way. They have their own dynamics in terms of the way the inflation is, where their currency is placed, where their economy is. Coming to India, India would definitely follow it over a period of time, but might not do it immediately, because Indian economy has its own set of dynamics. India has its own rate of growth, it has its own levels of inflation, and on the basis of that, the Reserve Bank of India, maybe not sooner but not later, would definitely follow the suit, but not exactly mirroring the way the Federal Reserve has done. The sectors and stocks which would do better in case of a rate cut cycle when it comes to India are basically the IT companies. The IT companies are quite facing the US, and the moment the interest rate cut happens in the US, the spending by the US corporates increase because of the lower interest rates, and this boosts the prospects of the IT industry. The banks are the another sector which could benefit, because lowering of interest rates would mean that there would be a mark-to-market gain on whatever debt papers which they are holding. The another sector which would be beneficial across the globe is the consumer discretionary. Now with interest rates coming down significantly over a period of time, and that is the trajectory which could be in store, what could happen is that the consumption of goods and services across the globe, which are maybe discretionary in nature, would increase. This trend of a positive news of reduction in interest rates was reflective on the way the Indian stock markets and the global stock markets performed. The Nifty 50 was up by more than 1.7%, 1.71%, but the Nifty small cap and mid cap were unchanged. The FIIs, after a long break, are aggressive buyers in the Indian stock market, and they have bought equities to the extent of more than 16,000 crores. The DIIs were net sellers to the extent of 500 crores. The major gainers in this week were Nifty Bank, which was up by more than 3.5%, and Nifty Realty, which was up by more than 4.5%. But Nifty IT was down by more than 2.5%, for the reason that there has been a lot of catch up of IT positive trend which has already happened as of now. Nasdaq was up by 1.5%, and so was the S&P 500. The interesting thing which statistics which I wanted to share with you this week was that in last 1 year, the DIIs, the domestic institutional investors, have been buying Indian stocks to the extent of 38 billion US dollars year to date. In last 1 year, that has been the buying by the domestic institutional investors, and the FIIs have bought just stocks worth only 7 billion US dollars. Let us hope with the falling interest rates in the US, the catch up by the FIIs happen, and now it is the turn of the FIIs to support the Indian market. That is all for this week. Thank you.